With massive layoffs in nearly every sector, weakness in manufacturing, car sales, and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show on Stansberry Research. Well, we know the numbers. We know it's a strong jobs report. We know that unemployment has ticked down to 3.4%, the lowest since 1969. So we're talking soft landing. Are we there yet? With Adrian Day of Adrian Day Asset Management, will the Fed get what they want? Adrian Day, it's been a long time. Good to see you, my friend. Welcome to the Daniela Cambone Show.
Good to see you as well. Thank you for having me.
Absolutely. You know, just looking, we know the numbers by now, 517,000 jobs added in January. Adrian, does this type of job market, where there's 2 vacancies for every person looking, does this show that we still have a real inflation problem? What's your take?
Yeah, I think we still have a real inflation problem. I think we're going to see the CPI probably continue to decline for a couple of months before we get a rebound. But there's a few things we should say about the jobs report. There's no question, but assuming we trust the numbers, there's no question that was a strong report. But I would put in a few caveats. One is that December, January, they always have large seasonal adjustments. That's number one. Also, this year, there was a new, what they call a population adjustment, which would make the numbers higher. More significantly, I think, the ADP report, which is a private company, is showing far, far lower jobs growth than is the Bureau of Labor Statistics payrolls report. So there's a dichotomy, there's a discrepancy somewhere. We don't quite know where it is, but there's a discrepancy between the 2 reports. Now, one thing, and all of these are minor adjustments, but they all can add up. One thing, definitely, is that a lot of people are holding down 2 jobs now. Because, they used to have a decent middle management job, they got laid off, they're now driving Uber or something, but maybe they've got 2 jobs. One's in a restaurant, one's, somewhere else. And that's counting as 2 jobs on the payrolls report. So that's exaggerating the numbers. So there's all these little things that are going on, I think, with the jobs report. But the biggest 2 factors, frankly, are that the ADP report is showing one number, whereas the government is showing another number. There's a discrepancy somewhere that we'll have to resolve at some point. And the second thing, that's the most critical thing of all, contrary to what Janet Yellen was saying yesterday, the unemployment rate is always at its lowest immediately before a recession. That's normal. That's normal. We can go back for 30 years and see that. So I don't think having low unemployment means we're not going to have a recession.
What's also interesting, this is kind of like a tangent, but I'm interested to get your thoughts. I had Kevin O'Leary on recently saying that he can't even fill positions. Like he's basically begging people to come to work. And I hear this all the time, that people don't want, especially office jobs, they don't want to go into the office, or they don't want, what was conventional jobs anymore. I'm curious to get your thoughts on that changing landscape of how, what are people doing? I mean, where's all this income coming from that folks maybe don't feel they need to work, or is it just we've seen, many people who are perhaps contemplating retirement, taking retirement early? I mean, just your thoughts on the changing face of the job market in general, Adrian.
Yeah, no, you raised some good points. I don't pretend to be a labor economist or a labor specialist, but there's definitely several things going on. When you had COVID and the lockdown, when people were locked down or let's say restricted for almost 2 years, a lot of people who maybe are 60, 61, 63, thinking about retirement at some point, let's face it, that was a good opportunity to say, you know what, I don't think I'll go back. So there's no question that there's a lot of people who have taken earlier retirement than they otherwise would have done. There's also the factor you mentioned, a lot of people, even people who are employed, and you see that in Manhattan with the banks, even people who are employed do not want to go back to the office. You know, they've got used to, over a reasonably long period of time, people have got used to being at home, and working from home remotely is kind of nice. You know, you don't have to dress up, put a suit and tie on. You can go to the fridge and grab some food when you want. You can take the kids to where they need to go without asking the boss. What it does for productivity is a different question. But in answer to labor, yeah, there's people who don't want to go back to work.
Yeah.
It is a dichotomy, though. It's definitely, there is something going on, because I know down here in Puerto Rico, a restaurant told me he had to raise he was looking for a dishwasher. And I don't mean to be demeaning of menial work, but a dishwasher, he had to raise the wage to $19 an hour to get a dishwasher. I mean, to me, this is just astonishing. So something's going on, and I think it's a mix of all those things you talked about.
Just getting back to Powell and inflation, I just want to tie up these loose ends before we move on to the next topic. So, he recently spoke at the Economic Club of Washington, and regarding the robust jobs numbers, he said it kind of shows you why we think this will be a process that takes a significant period of time. Now, if we read between the lines there, what is he saying? That rate hikes will be around much longer than we originally thought, or how do you interpret that?
Yeah, I think what he's saying, I don't think we're going to see rates go much higher in the near term anyway than projections are, than the analyst consensus is. But we're going to see them stay there a lot longer. That's Powell's plan, to see rates stay higher a lot longer. But also, interestingly, there's been a switch from the emphasis, I would say, from April until middle of December, really. It was an exclusive emphasis on raising rates. We heard very little about QT. We heard very little about the Fed selling off their assets in the balance sheet. Very little. In the last 6 weeks, that's come to the fore a little bit more. And I think what we're going to see is rates maybe plateau fairly soon, but then we're going to see QT step up. And QT is much more meaningful for markets, for assets, even than interest rates.
And I just thought I would bring up this quote. I was watching an interview with former Treasury Secretary Larry Summers just in regards to soft landings. He said, quote, "I said often that soft landings are, as Samuel Johnson said of second marriage, the triumph of hope over experience. But from time to time, hope does triumph over experience. So it looks more possible that we'll have a soft landing than it did a few months ago."
Well, I disagree with that. But I agree with his general comment, but I disagree with the conclusion. One thing we have to remember about what your previous question about are we staying with higher rates for longer? Let's not forget, we had an extraordinarily long period of excessively easy money, not just from 2020 with COVID, not just from 2009 with the great financial crisis, but really all the way back to Alan Greenspan, where we had an easier money, a looser policy than was justified by the economy. So over the last 30 years, we've built up a huge amount of distortions in the economy. So it's going to take to think that 1 year, less than 1 year, to think that less than 1 year will deal with that problem is foolish, I think.
And that's such a good point, Adrian, and it makes me think, can we ever get to a comfortable area where we're not, over easing or over tightening? Are you hopeful that there can be a middle ground?
Well, the Fed over its 100+ year lifespan has given us no reason to be particularly confident of that. You've asked these 8 people sitting around a room on the Open Market Committee to fix the price of the most important price in the economy, the price of money. That has to lead to a certain amount of hubris. And the Fed is always trying to walk a tightrope, to fine tune. And to me, it's an impossible task. It's not that they're doing their task badly. It's just that the task, which they are, is just that the task is impossible.
I want to switch gears here and talk about the anniversary of Brexit. Yes, I'm taking you back in time, Adrian. I know in another life we spoke and covered that extensively. And it coincided with a grim verdict from the IMF. They said that this year, the British economy will do worse than all of the world's major economies, including Russia. Bloomberg Economics estimating that British GDP would be 4% higher had it stayed in the EU. And one more thing I'll add, according to one survey, a clear majority now believe of Britons that leaving the EU was a bad idea, and almost 2/3 want a future referendum on rejoining. Why do I feel you have a lot to say on this?
Well, I haven't, on that last point, on a majority think it was a bad idea, I haven't seen that survey. I think it's a mistake to blame the state of a British economy or the UK economy solely or even at all on Brexit, frankly. What happened after Brexit, unfortunately, Boris Johnson, with a lot of enthusiasm, started doing the things that were necessary. That was in the trade deals with different countries. The EU remained a thorn in the side of Britain. But then, of course, we got COVID, and we can say a lot about Boris Johnson, but he just didn't follow through, frankly. He just didn't follow through on what he said he would do and what was necessary to do after Brexit. So I don't think Brexit was a mistake. Believe me, if we were still in Europe, I can guarantee a majority would still be wanting to leave. In Britain, we've never seen ourselves as part of the European continent, and frankly, the Europeans have never been particularly happy with us in Europe. And we just don't like other people telling us what to do. What this does do, if I can, an investment sort of a conclusion from this, there's no question that the UK economy right now is in a pretty poor state. What's happened over the last several years, of course, is the British pound has gone down dramatically. It was 170, 180, it's now whatever, 120 or something, got as low as 103. And British stocks have also not been as robust as other markets around the world. So we have a pretty good opportunity right now, frankly, in UK stocks, which are cheap. They have high yields, typically 5 to 6% yields. They're trading at single-digit or low double-digit price-earnings multiples. And if you look for the exporters, and most of the British market is exporting companies, unlike some countries, exporters, of course, benefit from the lower pound. So for a US investor or foreign investor anywhere outside of Britain, you can buy some pretty good quality companies at pretty good prices right now in Britain.
Interesting. So let's go a little bit further because I want to learn more about your investing strategy. There's just so many different thoughts. I just read an interview with Ray Dalio saying he'd be out of stocks and bonds, more in on cash. Give us a little bit of a breakdown. So you obviously said you like the You like some depressed British stocks right now. What else are you liking, and how liquid do you want to be right now?
Right. Definitely overall a lot more cautious, and let's say much more disciplined overall, generally. And that inevitably means more cash than normal. If we can start with the US market, I think the US market is just prepped for a fall. It is, I think it's back in a mania phase. You look at call options ratio, you look at what's happening with the AI stocks. I mean, the mania is back. And the market, up until today, is just not taking the Fed seriously. Uh, Look, if we had a bear market, sorry.
No, I was just going to say, I mean, we just concluded a January where you could make the argument it was almost hard to lose money. So you're right.
That's right. And you look at the, we had a bear market last year, um, and we got down as low as 18 times earnings multiple. Bear markets do not end at 18 times earnings. If that was the bottom for the US stock market, that is one for the history books. Right now we're at 18.7 times multiple. And you look at analyst consensus estimates for earnings for the S&P for next year are down less than 1% on last year. Essentially, they're flat. Now, I may be completely wrong, and we may have a strong economy this year. But if you listen to the earnings reports we've had so far, they would suggest earnings are going to decline this year by a lot more than 0.5%. And so what I'm saying is you've got a high multiple. Remember, absent the last 10 years of this excessive easy money, which drives stocks, 18.6 is a high price earnings multiple historically for the market. So we've got a high price earnings multiple, and we've got forward earnings basically flat. So you only need a small reduction in earnings, which I think is baked in the cake, which will mean a PE compression. You could see stocks go down another 20% easily. So I'm not, when we've invested very, very little in the US,
Okay.
very, very little. Got some high dividend yielders. I'm not. I think in this kind of environment, inflation higher and the dollar lower, typically smaller markets tend to do better than the major developed markets. So we are looking around the world for opportunities, and frankly, opportunistic. There's no grand theme, but we're seeing those opportunities in the UK for reasons we just mentioned. We're seeing them in Hong Kong. You've had the China repression in Hong Kong. You've had the China lockdown, which is just lifting. And we've had a big bounce in Hong Kong. But many of the stocks are still trading at low single-digit earnings multiples. Low single-digit. And we've got a whole slew of stocks in Hong Kong that are ridiculously cheap. And as China continues to recover from the lockdown, those stocks are going to do well. The big fly in the ointment right now, of course, is the China-US conflict over the balloon.
Yeah, I just had a good conversation with Lynette Zhang about that. I mean, yeah, just curious, what is your take? I mean, I was saying to her, like, are we really surprised that the Chinese would be spying on us? I mean, it is the second largest economy in the world. The US has the largest spy apparatus in the world. And, like I told her, hello, TikTok has been spying on us forever. So
I think there's a sort of unwritten rule. Everybody spies on everybody else. But when you're caught, you just have to accept the consequences. That's what happened. So, yes, I mean, it's idiotic to say, to get on a moral high horse about it. It might be bad from a military point of view.
Yeah.
So we're seeing opportunities in different markets around the world, and sometimes, frankly, they're just very, very short-term opportunistic trades. Now, by nature, as I think you can remember, I tend to be a much more long-term value investor. I like to buy things and hold them for a long time. In our managed accounts, which we started in 1991, I can still say this because I'm not telling what the performance has been. We still own Nestle, which was the very, very first non-gold stock we ever bought in our accounts in 1991, and we still own it. So I tend to be a long-term holder, but I think in this kind of environment, we're going to see more volatility. You just have to be shorter-term oriented.
And I know you just came back from a resource conference in Vancouver. Obviously, you're heavily
Yeah.
involved in the mining sector. Your thoughts on the precious metals mining sector, which we know has had a tough run here. I'm hearing there was, fantastic attendance. Is that a sign of the times? Your thoughts?
Well, I wouldn't call it fantastic. I would say it was a lot better than last year. I mean,
Yes. Yeah.
hugely better than last year,
Yeah, I'm
but
not
still
talking
down from
2012.
4 or 5 years ago.
Right.
Yeah,
Yeah.
no, not at all. But there's definitely a renewed interest coming into gold, and it's coming in from a lot of different areas, not only central banks, of course, which you and and all your listeners know about, but um, I'll tell you one thing. Yes, there were more people in Vancouver and they were more interested in the stocks. These tend to be the junior stocks, more interested in them. And there was more movement in stock prices following the conference. In my business over the last 12 months, um, I have had more people call to open an account in gold than I think I've had since 1996.
Wow.
But
Okay.
here's what's really, and it's not that we're doing more promotion
Yeah,
or we're
no, no,
better at
but I
marketing or
appreciate
anything.
those insights.
But here's what's fascinating to me. 1996, 1997, everybody called and said, hey, your accounts were up 110% last year. I want a gold account. They'd open because of a performance and they'd leave as soon as they didn't get that performance. The people I've been getting in the last year have been largely conservative older investors saying, I'm worried about what's going on, and I think gold is where I should put some of my assets. That's a completely different
You
mindset.
just beat me to my follow up. I was going to ask you if you saw a shift in demographics, if you were seeing younger folks interested, but you said it's still relatively.
Uh, I mean, younger in the sense of 50.
Yeah, yeah, yeah.
That's young, right?
Well, 50's the new
Yeah,
30.
we're
So,
getting younger people. I mean, because if you go back 10 years, our average client was about 67 years old. It's moved down a bit since then, but we're not getting 20-year-olds signing up.
right, right,
Um, but what's interesting to me is the objective has changed
right.
in the last 12 months. People want security. And I think you're seeing that in a lot of different ways. You're seeing that with the coin dealers and the shortage of coins, the huge premiums. People just, if you look at last year and you're a reasonably conservative investor or money manager, reasonably conservative, you lost 20% on your stocks. 20%, unless you happen to be really lucky. That's what the S&P lost last year. And bonds weren't a hedge. The short-term
That's
bonds
right.
were down 7, 8%, the short-term bonds. So an investor, a reasonably conservative investor says, I need to put my money somewhere more safe. And bonds don't seem like a very good idea with interest rates moving up. The market is volatile. So where are you going to put it? Bitcoin?
Well, I know, and Adrian, last year I know gold was taking so much heat. Folks saying, "Well, it should have been much higher given everything happening on the geopolitical front." But to your point, you would have been much better off being in gold.
Well, absolutely. And yeah, no, absolutely. I think people misunderstand gold last year. Gold, as you just mentioned, gold and silver, both held up very, very well compared with pretty much everything else you could have invested in on a broad basis. But the other thing that's really important is gold typically does not have, and this will surprise people, does not have a high current correlation with inflation. It tends to move up when the Fed is clearly behind the eight ball on inflation. And so if you look at the 1970s, for example, the last big inflation we had in the US, people like to denigrate poor old Arthur Burns, and I can join in with that as well. But people forget Arthur Burns was consistently, month after month, quarter after quarter, raising interest rates. The problem was that he was lagging inflation, and people did not believe that he had the fortitude to beat inflation. And so gold went up. As soon as Volcker came in and jacked up rates way above inflation and made people believe he was going to kill inflation, people believed him and gold collapsed. And right now with Powell and the Powell Fed, I think people are not, they're not either at either extreme. Some people are, but I mean, the market generally doesn't either think he's going to be a total failure, nor do they think he's going to necessarily succeed.
Does Powell does he want to go down in history as the new Volcker?
He definitely doesn't want to go down as the next Arthur Burns, that's for sure. But he's got a much more difficult job, I think, and I'm not defending him, far be it from that. But you know, we've had this excessive easy money for so much longer. It is built into the system. We had interest rates of zero. So going from zero, Fed funds rate, so going from zero, lower bound in the US, so going from zero to 4.25, 4.5 in less than a year is a pretty dramatic increase in such a short period of time. That's why he's switched to this higher for longer narrative, because they simply could not continue raising rates at this rate in a short period of time without killing the economy.
This is going to sound like a crazy question, perhaps. Could you make the argument that life is better, and I know it depends for whom, that life is better under QE? Life was better?
Life is better in the sense that, you know, I'm spending money that I don't have, borrowing money at zero interest, and the problem is that cannot go on forever. And so is it better? You know, you look at the last 20 years, people at the lower half of the income and asset category in the US, they actually saw real wages go backwards. They saw net asset value of the lower 50% also went backwards. So easy money helps people at the top. There's no question about that. The easy money policies after 2009 actually exaggerated the wealth gap in the US. Because easy money flows first to, you know, the money center banks, and it goes to high net worth people who can borrow. So who was borrowing money? Who was taking advantage of those zero interest rates? It wasn't, you know, as they say, Joe Lunchpail, which is very condescending, but anyway, it's a common expression. It wasn't the working person who was borrowing at 0%. Some people in the middle had the benefit of lower mortgage rates, no question. And that was a benefit. But most of the benefit flowed to the people who were already wealthy.
Adrian, I thoroughly enjoyed this conversation. And I want to just leave you with the last word. I know we covered a lot of topics, but just for the folks watching at home, do you have any just final thoughts about everything that we're going up against right now?
Yeah, these are very difficult times. What I would say is that typically when a market turns, and I'm thinking of the US stock market now, it turns very, very quickly. It is always better to be ahead too early than too late, because psychologically, if you miss the top to sell and stocks are down 5, 10, 15%, you always wait for them to come back. So it's always better, and frankly, it's easier to sell on the way up when things are already high and forget about missing out on the last, the last dollar.
Beautifully said, Adrian Day. I am so grateful and thankful we have reconnected. Thank you for joining me here today.
Yes, same here. Thank you for reaching out.
I really enjoyed that.
Appreciate it.
And thank you all for watching. I hope you enjoyed it as well. Please be sure to stay tuned to the Daniela Cambone Show here on Stansberry Research and sign up at danielacambone.com so you don't miss any of it. That's it for me. Thanks for watching.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.